One of the things I find quite fascinating about trading is how people can buy and sell at the same time or at different times and still achieve their objectives. The financial markets are a place where everyone can express their opinion. People can trade with the same or different strategies and styles, and they can potentially make or lose money by using them. Just because one trading strategy or style works well for one person, it doesn't mean that it will work well for somebody else. In this one, I will explain the different styles and strategies of trading, so you can learn what style or strategy of trading you might prefer or be best suited to. I will also outline the pros and cons of each of these styles so that you can better understand how each one will help you achieve your trading objectives. Welcome back. My name is Chris and I've been trading and studying the financial markets for a while. During that time, I have made many trading mistakes, such as bouncing from one strategy to the next, trading in ways that didn't suit me, and allowing short-term losing trades to turn into longer-term losing ones. I eventually realized that what might work well for one person might not necessarily work well for me. There are as many ways to trade as there are traders, and you only need to find one way that will. My hope is that this one will help you along the way to figuring that out. Also, you will want to stick around to the end because I will be disclosing a special promo code so that you can use when you make your next deposit. So with all that being said, let's get started. In the main, trading strategies are generally characterized as either trend following or mean reversion based strategies. I will explain what this means. Trend following requires you to look at the bigger picture and try to determine what the dominant price trend is. Then take trading opportunities in the direction of that dominant price trend. The underlying principle of mean reversion based strategies is that market conditions push asset prices in one direction or the other. When the price has moved far enough and the buying or selling pressure wanes, a correction can be expected to occur. This correction or reversion back to a mean or average price is like the market seeking its equilibrium. Mean reversion basically involves taking counter trend trades when the price is overextended back to some mean or average price. There are subtle differences and similarities between these two types of trading strategies. The difference between them is a matter of perspective and the time frames that you choose to trade on. Their similarities are that price must trend in the direction of your trade in order to make money. Even mean reversion based strategies involves trading price trends just on a shorter time frame that can run counter to the dominant one. In either case, to make money trading, you must buy at one price and sell at a better price, even if it is just for a few pips. So the trading strategies someone employs can be further characterized into different styles of trading. Think of this like martial arts. The strategy is simply to defend or attack, but there are many different styles of martial arts someone can use to do that. Much like trading, your strategy requires both offensive and defensive maneuvers to maximize profits and minimize the risk of loss. So let's talk about these styles and what the pros and cons are for each of them. I'm going to start with styles that have the shortest time horizon or that are most commonly used on the lower time frames, then work my way up to styles most commonly used on higher time frames and end with an overview of all of them. You are probably using one of these four common trading styles or in combination. The first one is called scalping. This style is a very active form of trading. And the objective of scalping is to trade in high frequency to try and make small but very frequent profits. Scalpers are looking to take advantage of the smallest price fluctuations in the market. Sometimes robots are employed to make these fast and frequent trading decisions, and it is not unusual for them to make hundreds of trades per day. Scalpers typically have tight stop losses and very small profit targets. The risk to reward ratios are typically under 20 pips and trade durations can range from milliseconds to maybe up to an hour. It depends on the market being traded and the technology being used. This is basically your rapid fire, instant gratification style of trading that is nearly all technical analysis based on sub 15-minute charts. Network latency and price slippage can critically affect this type of trading style. Any delays in execution speeds and widening of spreads can also result in significantly worse price fills. This can mean the difference between making a profit and a loss. Scalping is the most sensitive to market and platform conditions of all the trading styles that will be mentioned here. Let's highlight some of the advantages of this style of trading. There are a high number of trading signals and opportunities to trade daily. Reduced time in the market on a trade-by-trade basis can potentially reduce your risk. There is potential to make money very frequently. There is a high probability of reaching profit targets because they are close by. Now let's highlight some of the disadvantages of scalping. There can be a high number of false trading signals when they come. Price movements on the chart may seem more erratic and random. There is a higher probability of price reaching your stop loss if it is close by. Transaction costs generally equate to a high percentage of profits and high in general due to the high frequency of trading. Scalping is very sensitive to network latency, price slippage, spreads and platform instabilities. More overall screen time is required to trade this style and generally manage the trades. The second style of trading is called day trading. A day trade is defined as all styles or types of trading that involves buying and selling within the same day. Scalping can also be classified as a form of day trading. The objective of this type of trading is to try to benefit from intraday price momentum. This trading style mostly adopts a technical approach. However, economic or political news announcements can also be used as catalysts for trading decisions. There are usually several intraday price trends that day traders can try to benefit from, and these relate to the intraday price trends that may unfold between each of the 3 trading sessions, which are the Asian session, the European session, and the US session. Day traders can use any of the intraday timeframes to help them identify trading opportunities, and deals are usually held for times ranging between minutes and hours. Price objectives could be anything from 20 pips several times a day to the average daily price range for the currency pair on a single trade. Let's highlight some of the advantages of this style of trading. Trading signals and opportunities to trade exist daily. Low time in market can potentially reduce your risk. The potential to make money exists daily. Higher probability of reaching profit targets if they are placed close by. There is no overnight market risk or swap fees for carrying positions over to the next trading day. Now let's look at some of the disadvantages of day trading. More screen time is required to monitor the trades and to manage them. A high number of weaker trading signals can occur if the longer term trend isn't being taken into account. Intraday price movements may seem random and hard to read if you are a beginner. There is a higher probability of price reaching the stop loss if it is close by. There is some sensitivity to network latency, slippage, widening of spreads, and general platform instabilities. The third style of trading is called swing trading. Swing trading is a type of trading that requires you to hold on to deals for a more prolonged period of time. Unlike day trading, deals are usually carried overnight to try to capture larger price moves. Just like there are intraday price trends, there are also intra-week or intra-month price trends. Swing trading involves trading with this price momentum. A swing trader must be patient to wait for fewer trading opportunities and disciplined enough to hold trades for longer periods of time. This is compared to day trading or scalping. A typical holding time for a swing trade can last from days to weeks. There are usually about 3 good trading opportunities per week per currency pair with this trading style. It all depends on what is happening in the markets. Price targets and stop losses are generally placed further away than what they would be while day trading. This is to take into account the larger price movements seen on the higher time frames. A typical stop loss for a swing trade could be 50 to 100 pips wide, and profit targets could be the same or several multiples of this. Swing trading involves analyzing the market on the higher time frames, such as the daily, the 4-hour, and the hourly candlestick charts that can be used to fine-tune the entries and the exits. Swing trading requires less monitoring and trade management, and the potential exists to capture larger price movements. This is a great style of trading for people who can't commit to watching the markets often or prefer to monitor the charts less frequently. Let's highlight some of the advantages of this style of trading. Trading signals and opportunities are more significant on the higher time frames. Potentially, you can capture larger price trends. When conditions allow it, deals can earn interest from the overnight swap. Less screen time is required to monitor and manage the trades. Wider stop losses might reduce the probability of getting stopped out. Transaction fees can be a lower percentage of the overall profit in general. Now let's look at the disadvantages of swing trading. Fewer trading signals per week can reduce the potential to make profits frequently. More time might be required to recover from the losing trades. More time might be required to allow the trade ideas to unfold. It's possible to have a negative cost of carry from the overnight swaps. You must be disciplined enough to sit through price corrections against your trade. Wider stop losses are also required, which could mean smaller deal sizes. The fourth and final trading style on this list is called position trading. Position trading is very similar to swing trading, but the main difference is that a position trade sizes up the broader market trend and can hold deals for a much longer period of time. A position trader could hold deals for months or even years, and this type of trading might even be considered something that's bordering on to investing. Position traders pay less attention to short-term price trends, and more weight is placed on the weekly, monthly, or yearly trends when making decisions. These decisions also take more fundamental drivers into account and not just the technical ones. Position traders will pay particular attention to seasonality in markets, the health of a country's economy, interest rates, and other geopolitical events. Since positions are being held for much longer periods of time, position traders prefer to benefit from the swap. This means that deals will accumulate interest from holding the currency from one trading day to the next. Let's highlight some of the advantages of this style of trading. The trading opportunities are very significant. Potential exists to benefit from significant price trends. Deals can potentially earn interest from the overnight swap. Less screen time is required to monitor and manage the trades. Wider stop losses can reduce the probability of being stopped out. Transaction fees are relatively insignificant relative to the potential profits in general. Now let's look at some of the disadvantages of this style of trading. There are few good trading opportunities per year. More time might be required to recover from losing trades. More time is required to allow trade ideas to unfold. It's possible to have a negative cost of carry from overnight swap. You must be extremely patient and very disciplined. Much wider stop losses are required, which could mean smaller deal sizes. And that concludes the list. There is a style of trading here for everyone. However, not all types of trading will be suitable for you. You should consider how much time you have to follow the markets, what your trading objectives are, the size of your account balance, and your tolerance to risk. Let's summarize all of the styles into a single snapshot. Scalping is the most active, shortest term style of trading on the list. Scalpers naturally gravitate to the lower time frames to see the short-term price fluctuations, typically using the 1 minute, 5 minute and 15 minute charts. Because of this, trading will be fast-paced and opportunities will be very frequent. You will also have to be prepared to make decisions quite quickly with this style. One thing you need to be very mindful of is allowing a scalp trade to turn into a longer term trade. That's fine if you are letting profitable trades run, but allowing the losers to run can be quite devastating, since the profit targets are generally very small with this style of trading. Then we spoke about day trading. This is a good style of trading for you if you have some time to follow the markets on a daily basis and you still want to trade somewhat frequently throughout the week. This is a good style of trading if you don't want to carry positions overnight and you want enough opportunities to recover from drawdowns relatively quickly. Typically, day traders analyze the market using the 15-minute, 1 hour and 4 hour charts. Then we have swing trading. This is where medium-term trading begins. This is a good style of trading if you have limited time to follow the markets and you want to be more composed when trading. There are few good trading opportunities weekly with this style, but the profit potential can be quite healthy. That somewhat compensates for trading less frequently, but you will naturally need wider stop losses to let your trades breathe with this style of trading. One thing you need to be mindful of with this style of trading is that you need to be patient as a swing trader because opportunities are less frequent than the previous two styles, and recovering from drawdowns can take a little longer. One thing you can do to compensate for this is to follow multiple markets to increase the number of trading opportunities that you will get. Swing traders typically gravitate to the 1 hour, 4 hour and daily charts so that they can look at the bigger picture. And lastly, we spoke about position trading. This is a good style of trading if you don't have much time to trade, but you still want to be involved in the markets. Trading opportunities are less frequent, but the holding times when trades do happen can last for months or years. One thing you need to be very mindful of with this type of trading is using high amounts of leverage. Position traders naturally gravitate towards the highest time frames, which includes the daily, weekly and monthly charts. And because of this, stop losses and profit targets are naturally very wide. You can be equally successful trading with any of these styles as long as it is the right style for you. So, with all this being said, it's just about time to wrap this one up. I hope you found this useful. So, hit the like button, subscribe for more content, and leave your comments below. Tell us what your favorite trading style is and why. But just before I go, here is that special promo code I said I would give you earlier. Visit www.TIOmarkets.com and use promo code YT25bonus. This will credit your account with an extra $25 when you get started. You can trade this using any strategy or style that you like. So good luck, and I will see you in the next one.